Hello, hello. So back in January, Microsoft kind of shook the gaming world by purchasing Activision Blizzard for a whopping $69 billion. And everybody was expecting Sony at some point to reply. And they did. It looks like they are set to buy the well known Destiny's video game developer Bungie in a much, much lesser deal in terms of price, $3.6 billion. But I think it's their highest, their biggest acquisition, really. So in this video, I wanted to examine Sony as a whole. And obviously, right now, the company stock price has been really blowing up and going higher and higher. And you will see here in the snapshot, the overview snapshot, really. Now, the company is paying a little bit of a dividend, 0.36. That's a little dividend, but okay. We will examine the payout ratio. It has outstanding shares of $1.24 billion, as 1.24 billion shares, and used to increase and increase and increase quite a lot actually, about 20% here, and then there's a little bit of a decline, which is nice to see lately. And you will see here also that the company stock price grows higher and higher, and their current PE is 16, which is actually impressive base if you actually think about their stock price having been so high and growing higher and higher. So we'll take a little bit of a closer look here, see how much money the company makes and whether it is an interesting acquisition. Company being up 13.74% in the last year. So one of the companies that's doing really well despite the recent downturn. So the dividend of the company has a payout ratio of 7.2%. That's nothing. I mean, it's almost zero. So I wouldn't mind that at all. It's a little bit of a benefit without the company missing anything really in terms of their cash flow, it looks like. So the income statement of the company here. Let's take a little bit of a closer look. Always going back a little bit to 2017 to 2022. That's more than enough. And the year-over-year growth of the company seems to be increasing now. The thing is, with the pandemic, you would expect the company's revenue to increase, sell more games, just because, again, it's the current pandemic that helps with that a lot. The gross profit is sitting at 13% in terms of their growth, really. And overall, they look to be, getting more and more money here. But what about the net income? The net income of the company used to be 658 million back in 2017, and now it's 8.5 billion. That's a massive increase, as you can understand. So the company is growing tremendously well over here. Although it did slump from last year, from 2021, still there's a massive increase in terms of its net income here. So doing really well. What about the balance sheet? And the balance sheet over here, the total assets of the company also increasing, but we do want to check the liabilities, which is close to 200 billion here. That's a lot of the liabilities, but their total equity is $64 billion. So a lot of equity here, and used to be 28.2. So company doing well on that front as well. Cash flow. The operating income, basically the cash from operations, operating activities, 7 billion here, 9.5 billion here. Increasing, I mean, but it has also suffered in some situations, and I'm a little bit surprised that it's actually in the last 12 months is actually less than what it used to be earlier. So that's a little bit maybe potentially concerning. But let's take a look at the most important thing here: the free cash flow. 4.25 billion here, 9.3, 8.5, 8.5, 7.5, and 5.3. So it's decreasing here, and that's not great to see. I'm wondering whether this has to do with competition from Microsoft and obviously, other gaming services. But the fact that it is increasing, it's just generally speaking not great. However, we do want to also include in our calculations the previous years. And you will notice here that if you get an average of this, you're looking at about let's say $6 billion in terms of free cash flow. If you give that a multiple of 20, multiply that by 20, meaning you're getting $120 billion in terms of the market cap, and right now the company is sitting at 137. So if you take 6, which is the current average, about 6, could be a little bit more, and multiply it by 30, then you get $180 billion of market cap. So we're sitting at around 22 to 23, I believe, in terms of the multiplier or the free cash flow multiple here. And that's obviously pretty good. I mean, the company seems to be increasing its growth year over year, although you have to be a little bit concerned about the free cash flow going down. That is a little bit concerning, and you may want to dig a little bit deeper, see what causes that. Is it the capital expenditures here? It doesn't look like that's the case. Looks like it's mostly operations, so they actually made less. And this is something that could potentially be a little bit concerning here, maybe. But I do like the fact that they are making a lot of free cash flow here. I do not like the fact that they have a lot of debt. I don't like that. They have a lot of liabilities here. Remember, we noticed that earlier. Many liabilities, $200 billion, that's a lot. Wonder how that shows here. Yeah, over here it shows like 37 to 0.3%, just because they have a lot of equity, I'm assuming. But their debt is a lot, and yeah, this is also kind of reflected on the Altman Z score. I don't like that, because the company is making $6 billion in free cash flow, let's say 6 on average, and they have 200 million in terms of total liabilities here. That requires around 30 years of free cash flow or more for repaying the debt. And while the debt can be a good thing, I don't like that much debt. That's a little bit too much for me, and looks like it keeps increasing as well. So the company is basically really looking into its operations to fund that debt eventually, and hopefully they will continue growing greatly. Otherwise, they could suffer from this kind of massive debt here. I don't like. I'm a little bit worried about this much debt. So what would I do with the company? If the company didn't have that much debt, I would buy it. But I'm really concerned about it. This kind of debt is a lot, and it doesn't really show that well over here. You have to see it with the balance sheet really, and the liabilities. So I'm wondering why they let this get out of hand that much. That's a lot of debt over here. So yeah, this fact actually has me a little bit worried, the fact that they have that much debt. And so they still have quite some equity here, and this is where the debt to equity is not like super insane, I'm assuming. But yeah, the fact that they have that much debt is kind of making me worried, and so I would rethink about it. I would think it twice, and I would want to get it at a much steeper decline, just to have a little bit of a margin of safety for myself, just because of this debt. I like the fact that they are making a lot of money, but I don't like the fact that they have decreasing cash flow. That's also a worrying sign. The fact that they have a lot of debt is a worrying sign. And also, there's obviously a lot more competition coming in, and regardless of the fact that I personally do have a PS5 and I love it, I have to check how it works with the company in terms of its financials. And this kind of metrics here, while the company does make a lot of money and their operations are doing well, they are slowly decreasing, and they're having more and more debt. So I think I will actually not buy Sony right now. But for somebody who is interested, maybe you want to just wait it out a little bit and try to get it at a better price potentially. Again, there's a lot of debt here concerning. So I hope you enjoyed the video. If you did like it, please take a look at our Discord channel. There's a link below in the description box. We'd like to see you there. And in the meantime, you may take a look at this video that I made a little bit earlier about JP Morgan Chase and the stock price and the company. So thank you for watching, and I'll see you in the next one. Bye bye.